Welcome to this guide on how to use the action report. The action report gives you day-by-day trading instructions for every predicted turn date in your dates report. So what exactly is the action report? Think of it as your day-by-day trading guide. While your dates report tells you when a trend change may occur and what direction to expect, the action report tells you exactly how to trade it. Each predicted turn date gets its own page in the action report. You'll see whether to trade or skip that date, a step-by-step action plan, and risk management guidelines specific to that prediction. The key point to remember: the dates report shows when and what. The action report shows how. Let me show you how the two reports connect. On the left, you see your dates report with dates and signals. For example, July 21st, 2014 shows a minor low. The action report takes that date and expands it into a complete action page. It shows you the convergence score, tells you to watch for a low formation, provides entry instructions like buy after confirmation, specifies your stop loss at 2 to 3% below the low point, and recommends your position size based on the convergence level. Every date in your dates report has a corresponding page in your action report. Each page of the action report follows a consistent structure. At the top, you'll see the date and day of the week. Below that, you'll find which cycle levels are converging on this date, followed by the convergence score and status. The trade or skip status is important. If a date falls on a weekend or holiday, the report will clearly say skip with a warning. Only act on dates marked trade with a check mark. The predicted turn section shows if you should expect a high, which is a sell signal, or a low, which is a buy signal. The most important section is the action plan. This tells you exactly what to do before, on, and after the predicted date. We'll cover this in detail in the next few slides. The convergence score shows how many of the 4 cycle levels agree on the same turn direction. A score of 1 out of 4 is low convergence. Only one cycle, typically the minor cycle, is predicting this turn. In this case, use a smaller position size, around 40 to 50% of your normal size. A score of 2 out of 4 is medium convergence. You can use 50 to 70% of your normal position. A score of 3 or 4 out of 4 is high convergence. This is when 3 or more cycles agree. These are your highest confidence signals, and you can use 80 to 100% of your normal position size. Remember, higher convergence means higher confidence. Always adjust your position size accordingly. Let's dive into the action plan, starting with what to do before the predicted date. Preparation is key. The report will tell you exactly when to start, typically 3 to 4 days before the predicted turn date. Step 1. Review your charts. Identify the current trend direction. Is the market trending up or down heading into the date? Step 2. Set price alerts around key support and resistance levels near the predicted turn date. Step 3. Prepare your orders. Pre-plan your entry point, stop loss level, and target. Have your orders ready to execute. Step 4. Free up capital. Make sure you have sufficient funds available to take the position when the signal confirms. When the predicted date arrives, here's what to do. Watch the market closely from open to close. Look for the predicted turn to form. If the report says expect a low, watch for signs like the downtrend breaking, hammer candlestick patterns, or increasing volume on upside moves. If the report says expect a high, watch for uptrend exhaustion, shooting star patterns, or fading volume on rallies. The critical point: act only when the turn confirms. Don't anticipate. Wait for the market to actually make the turn before entering your trade. Remember, the turn may not happen exactly on the date. Each cycle level has its own deviation window, which the report calculates for you. For minor cycles, it's plus or minus 1 day. For major cycles, it can be plus or minus 22 days. There are 3 possible outcomes, and the report tells you how to handle each one. The first and most likely outcome: the turn forms as predicted. This happens 85 to 86% of the time. If a low was predicted and it forms, buy after confirmation with your stop loss 2 to 3% below the low. Hold until the next turn date. The second outcome is called a polarity failure. This happens about 14 to 15% of the time. The market makes the opposite turn. If this happens, the market is showing strong counter-trend behavior. You can consider trading in the opposite direction, but use a tighter stop of 1.5 to 2% and reduce your position to just 30 to 40% of normal. The third outcome: no turn forms within the window. This is a timing failure, not a polarity failure. Extend your observation by 3 more days. Keep watching. Markets often turn late. Don't abandon the prediction. Be patient. Every action report page includes specific risk management guidelines. Here's the framework. For position sizing, low convergence signals get 40 to 50% of your normal size. Medium convergence gets 50 to 70%. High convergence gets 80 to 100%. For stop losses, the standard is 2 to 3% from the turn point. If you're trading a polarity failure, use a tighter stop of 1.5 to 2%. For account risk, never risk more than 1.5 to 2% of your total account on any single trade. And limit yourself to 2 to 3 simultaneous positions maximum. Remember, scale your position to the convergence level. Always use stop losses, hold until the next turn date, and trail your stop as the market moves in your favor. You are now ready to use the action report. Follow the day-by-day instructions methodically. Remember, the dates report shows when and what. The action report shows how. Use them together for the best results. May your trading never be the same again.